Welcome to This Explainer. Today, we're diving into a fascinating mystery hiding in plain sight, the digital scoreboard, and how bank lending actually, literally creates money.
Imagine you walk into a bank, right? You apply for a $10,000 loan. The bank reviews your application, they approve it, and then within seconds, your account balance just jumps up by 10 grand. Notice what didn't happen there. Nobody went down to a vault. Nobody moved physical stacks of cash to back it up. Your new balance is entirely a digital entry, a pure expansion of the bank's balance sheet.
Which obviously begs this huge, maybe even slightly uncomfortable macroeconomic question. Did the bank simply create money out of thin air? I mean, how is it mathematically possible for digital balances to just expand without physical reserves backing up every single cent?
Okay, let's dive into this. The answer is, well, sort of, but definitely not in the way most people think. The mechanics behind it are actually highly structured. So, we're going to unpack exactly how banks use lending to expand the money supply, why this system even exists in the first place, and the strict regulatory guardrails that keep our broader economy stable.
To really grasp this, let's ground it in a real-world story. Meet Ethan. Ethan's dream is to open a coffee shop. Now, he's got $20,000 in personal savings, his own equity, but he needs another $80,000 to actually launch. So he talks to his friend, a recent college grad named Mia, who helps him crunch the numbers. He secures a bank loan, and bam, the next day his account is credited with the funds. But seriously, where exactly did that digital liquidity come from?
Now, what's really interesting about this is the contrast between our physical expectations and the digital reality. Think of a giant stadium scoreboard. When a team scores a touchdown, the board updates instantly. No one is physically printing out points and pasting them up there, right? The score simply updates electronically. Modern banking operates on that exact same principle. The vast majority of money today exists purely as electronic balances. When a bank issues a loan, it credits the borrower's account with a brand new digital deposit. This instantly increases the total amount of money available in the banking system, all without a single physical bill being printed.
It's totally fascinating to trace the path of this new digital money as it ripples outward. So Ethan takes that 80 grand and he buys espresso machines, tables, wholesale beans. The equipment supplier takes Ethan's payment and deposits it into their own operating account. Then they use that capital to pay their workers. Those workers go out and buy groceries, and the grocery store turns around and pays its vendors. This one single loan begins circulating rapidly. It proves that a single update on a digital scoreboard actually supports a massive, interconnected chain of real-world economic activity.
A really helpful way to visualize this is to think of an economic water wheel. Imagine this massive, heavy wooden water wheel sitting perfectly still. It doesn't do anything on its own. But the second water starts flowing, the wheel begins turning. And as it turns, it generates power for everything around it. Bank credit acts exactly like that flowing water. Loans inject the liquidity that keeps the economic gears turning. This capital flow is literally what allows businesses to scale up, families to buy homes, and massive infrastructure to be built. The banking system leverages deposits and loans to finance very real, tangible economic growth.
But looking at this constant flow, you might hit a natural realization. The same skepticism Mia had when looking at Ethan's books. If it's all just a digital scoreboard, what mathematically stops banks from adding endless zeros to the money supply? Can they just hit a button and create unlimited money?
The short answer there is absolutely not. No way. The system is far from some free-for-all money printer. Before any loan is credited, banks are boxed in by incredibly strict constraints. First off, the borrower has to actually be able to repay it. Plus, banks have to balance internal capital requirements and daily liquidity needs, making sure they have enough reserves to cover potential outflows. On top of that, they navigate dense regulatory standards, robust risk management protocols, and constantly stress test against the overall macroeconomic conditions. Without these limits, creating loans would severely destabilize the currency. That's exactly why regulators are constantly supervising banking systems to ensure their lending capacity stays tethered to actual financial realities.
Actually, think of it a bit like planting a garden. You wouldn't take expensive, precious seeds and just throw them onto solid concrete, right? You plant them in healthy soil where they can actually grow and yield a return. Banks allocate capital with that exact same mindset. They evaluate creditworthiness because they need to plant financial seeds where the borrower can successfully manage the risk. Good lending supports healthy economic expansion. Poor capital allocation, planting on concrete, increases systemic risk for the entire banking sector.
Let's move forward and see how this builds over time. Once Ethan's coffee shop is up and running, generating revenue, he starts repaying his loan every single month. A portion of each payment goes to interest, which is the bank's return on capital, but the rest reduces the principal loan balance. And here is the crazy part. As the principal is repaid, the corresponding loan asset on the bank's books declines. This repayment literally reduces the initial deposit money that was created. So the financial system is almost in this constant state of breathing, inhaling as new credit is issued to expand the money supply, and exhaling as old debt is retired, contracting it.
To really appreciate why this breathing system is absolutely crucial, imagine a world entirely without bank credit. No commercial construction loans, no revolving lines of credit, no residential mortgages, nothing. Without the ability to leverage future income, large-scale construction just grinds to a halt. Businesses stall out before they even open their doors. Families are delayed by decades, forced to save up the entire cash value of a house before they can buy property. Bank lending bridges this massive gap. It allows the economy to pull future value into present-day investments.
Fast forward 10 years, and we can really see the long-term impact of this engine. Ethan's single coffee shop, it's blossomed into 3 highly successful locations. He steadily serviced his debt over time, completely validating the bank's initial risk assessment. Today, his business employs dozens of people. That neighborhood community, those jobs, the Jelly commerce, all of it was catalyzed by that one carefully calculated digital scoreboard update a decade prior.
And looking back at all this, Mia hits on a true aha moment. The loan didn't just capitalize Ethan. It fueled a whole local supply chain. It helped employees, vendors, the entire municipal economy. Banks don't create money just to hoard it on a spreadsheet. The whole lending framework exists specifically to accelerate capital velocity and finance widespread, tangible economic activity.
So the next time you hear someone say, banks create money out of thin air, you'll know the real nuance behind the headline. Banks don't just magically invent wealth. Yes, deposits are created through the mechanics of lending, but they are always tethered to an asset on the books. They operate inside a highly regulated infrastructure designed specifically to support broader economic growth. Regulators and central banks are working around the clock to maintain stability, ensuring this entire dynamic system of credit creation stays sound.
Understanding this process truly unlocks one of the most powerful mechanics of the modern macroeconomic world. So I want to leave you with this provocative thought. What future reality is your bank account funding today? Every single deposit, every loan, every digital number is a gear turning in that economic water wheel. If you enjoyed uncovering the mechanisms hidden in the numbers we use every day, please like this explainer, subscribe for more insights, and share this with someone who loves figuring out how the world actually works. Keep questioning, keep learning, and we'll see you in the next explainer.